Hi, everyone. Thank you so much for joining into our webinar today. My name is Sharon Cornelissen. I'm the Director of Housing at the Consumer Federation of America. At CFA, we are so pleased to be able to host this webinar on behalf of the Coalition for Federal Home Loan Bank Reform, which is a coalition that I chair. This national advocacy group has emerged as a powerful voice for federal home loan bank reform. They argue that the system has strayed from its mission of providing liquidity to banks and financial institutions for housing and community development, not just liquidity for any purpose. So why are we talking about home loan banks at all? Well, last year, the Federal Housing Finance Agency, also known as FHFA, started a wide-ranging inquiry into the home loan bank system. They met with hundreds of stakeholders all over the country in so-called listening sessions. And based on this extensive comment period in November of last year, they published a report called The Federal Home Loan Bank System at 100. In this report, they put forward many key recommendations for reform. Many of these recommendations can happen through regulatory action. Some of them also need congressional approval. So in today's webinar, I will talk to two of the most prominent experts on GSE reforms and banking regulations. We're joined by Don Layton, who is currently a senior visiting fellow from practice at NYU Furman Center. He knows more about GSEs than almost anyone else does. He used to be the CEO of Freddie Mac, which is one of the GSEs for 7 years while it was under conservatorship. And he's also the former vice chairman of JP Morgan Chase. He recently published a two-part paper in which he called out what he called the flawed system, the flawed model of the public-private hybrids that are GSEs, or government-sponsored enterprises. We are also joined here by Professor Kate Judge. She's the Harvard J. Goldsmith Professor of Law and Vice Dean for Intellectual Life at Columbia Law School. And she has extensively published on banking regulation and on financial crises, including a recent paper called The Unraveling of Federal Home Loan Banks. If there's anyone who could make banking reform sound exciting, it would be Professor Judge. I also would like to thank my CFA colleagues, Katie McCann and Anne-Marie Lowery, for making this webinar possible. So I will start with a conversation, but I will make sure that we leave around 10 to 15 minutes at the end for questions from the audience. So if you have a question, please type it in the chat function below. If you have a question during our conversation, you can feel free to put in a chat, but I will get to our questions at the end. Just a reminder that this webinar is being recorded, and a copy of the recording will be posted on CFA's YouTube channel afterwards. So Don and Kate, I'm super excited to have you here and really have this conversation about this important but also often complicated issue. So I'd like to start at the beginning and just, first let's kind of talk about why Congress chartered the federal home loan banks to begin with. So I'll start with Kate. The federal home loan banks, they go back to 1932. So it's a different time. So how were mortgages made back in 1932, and what problems was the federal home loan bank system meant to solve at that time?
Yeah, so first of all, Sharon, thank you so much for putting this together. It's great to be here with you and with Don. It is a really important and timely topic of conversation. And I think 1932 is a great place to start, because understanding the federal home loan banks today, we have to go back and understand the origins, what the system was meant to achieve. And in 1932, the system made a lot of sense. So first of all, it was very hard to get any kind of home loan in 1932. Mortgages were just scarce and hard to come by even before the Great Depression. And as soon as the Depression took hold, access to financing really dried up, and the housing market and housing starts really dried up. And so what the federal home loan banks did was, against a background where most of the mortgages that were made by financial institutions were made by member-controlled institutions known as thrifts. So you had savings and loans and building associations. The challenge these institutions faced is they did not have access to the Federal Reserve's discount window, which is what provides liquidity and support for financial institutions during periods of distress. And the Fed at that point in time didn't accept mortgages as collateral. And collateralized lending is the way that the Fed, as kind of bank to banks, help commercial banks stay viable during this period of time. So against that background, the Federal Home Loan Banks came in and they really served two functions. First, they played a lender of last resort to thrifts that were focused on housing finance. So they didn't have access to the Fed. They didn't have access to the Fed all the way until 1980. So one was to provide this liquidity backstop, provide these collateralized loans, serve as a bank to banks that helps maintain the viability of these small financial institutions, particularly during periods of distress when the Fed wasn't able to play that role. Second, it was really also to increase the availability of mortgage credit and to be able to make that mortgage credit on terms that were more favorable to consumers. So your average mortgage at that time was about 5 years, and it was very often a balloon loan. So you actually paid interest during those 5 years, and then you had the entire principal due at the end. And so what the Federal Home Loan Bank said is, first of all, we'll accept mortgages as collateral. So we'll help thrifts make more mortgages because they're going to, help them manage their liquidity. But second, we're going to make those loans on even more attractive terms by smaller haircuts if the mortgages that you're posting as collateral really help to serve consumers. That means they're longer term and also they're amortizing, that you're paying off the principal interest as you go. So what it did is it increased the availability of mortgage credit, and it made those mortgages, or gave the financial institutions really an incentive to make mortgages that serve consumers by taking advantage of the fact that at the time there was a close nexus between thrifts as financial institutions and the creation of mortgage credit.
Great. Yeah. So very helpful. So that was back in 1932. So we've had around 90 years, I guess, for the housing finance system to evolve. So this question for Don. So yeah, how have mortgage markets changed since then? Yeah.
Well, oh my, how have they not changed? I'm going to take almost 100 years, I'm going to take 3 snapshots of how mortgages worked in America. The first, Kate covered, the pre-Depression era, with these very short mortgages made by thrifts, which were not very prominent back then. If you fast forward to post-World War II, it was the era of the thrift. Thrifts dominated making mortgages in America, but the thrifts themselves have been remade by government policy, especially the creation of federal S&Ls in the 1930s, as opposed to all these local little member-controlled institutions. And they became big. They were kind of narrow banks without the word bank in their name. They took in savings deposits, average maturity probably several months, and they put on what also was developed by the government over time in the 30s. It became the 30-year fixed rate self-amortizing loan, and even free prepayment and all the bells and whistles that is very homebuyer friendly. And that was their balance sheet. They had to have most of their assets in those mortgages, and they had these deposits. It was all wonderful until inflation hit in the 70s, and all of a sudden people were able to withdraw their deposits and go for higher rates. And no one had really thought about the inappropriateness of a mortgage that has a fixed rate out a decade or more, funded by relatively short-term liabilities, and that led to the collapse of the thrifts. Usually it's called the S&L crisis in 1989. When it culminated, it really was the thrift crisis, and most thrifts disappeared at that point. The third snapshot, maybe 10 years later, starting in the mid-90s, late 90s, and since then, is mortgages are now dominated by the agencies. That means instead of thrifts as banks taking deposits in and making mortgages, mortgages make their way to the agencies, Fannie, Freddie. Some people will say Ginnie Mae. Ginnie Mae is the back end by which the FHA and the VA and even the Department of Agriculture securitize their mortgages. So that's your 5 mortgage lenders, with Ginnie being securitizer for 3. And they all eventually developed a securitization business model. It's known as the pass-through MBS, the pass-through agency MBS, in which institutional investors around the world buy these things They take all that complicated interest rate risk, and they're guaranteed by these agencies, government agencies, quasi-government agencies, about the credit risk in the mortgage. So to them, it's kind of a weird treasury that they're buying. And right now, of the 13 trillion mortgages outstanding, a little over 50% comes from Fannie and Freddie, and another 20 percentage points, so the total is over 70%, come from the Ginnie Mae securitizers. So it is government agencies that dominate the system. All of those government agencies are in one fashion or another subsidized and have been from the beginning. So it's preferential credit, and that was government policy. In Kate's description of the FHLBs and what they did, and we're going to talk about it, they were subsidized also, and they're still subsidized. The word subsidy has to be remembered. The other thing that's changed is, who do you deal with to make a mortgage? In the old days, it was the thrift, a quasi-bank, or banks, who eventually got into the mortgage business. These days, banks do there are people who do mortgages to hold on their books, like a bank, a traditional thing. Credit unions, others do it. But the vast majority, that 70+%, are sold. They're a temporary lender. It is sold to the agencies. And therefore, you don't have to be a bank anymore to originate, or a near bank, like a credit union. So it's these non-bank mortgage companies that are temporary lenders, and their business model requires them to sell the mortgage on. And that the most well-known would be like Rocket Mortgage and companies like that. And that's who makes mortgages these days. And that's where the money ends up coming from, through mostly these government agencies.
Yeah, and those independent mortgage banks, they're not members of the Federal Home Loan Bank system.
Just to be clear, the membership of the home loan banks was specified in legislation back in 1932 and has been amended. Congress has determined who can and can't be, and those mortgage bankers are not on the list.
So yeah, with all these shifts, the rise of securitization, and with other lenders kind of having emerged, my question to Kate is, yeah, what do federal home loan banks do now, and like, what's their role in housing today?
Yeah, so what they do now in the role in housing are actually two separate questions now. They're much more separate now than they were in 1932, precisely for the reasons that Don just described. So in 1932, the core role of federal home loan banks in 1932 and today is to make collateralized loans to member institutions. In 1932, most of those and for the 3 or 4 decades following it, most of those member institutions were thrifts. And most of those collaterals were residential mortgages. Much of that collateral was residential mortgages that were not otherwise all of that liquid. So there was a close nexus between membership and collateral and helping housing markets. As Don just described, that's no longer the case. Thrifts are a tiny portion of the Federal Home Loan Bank members today. Most are commercial banks. It also has long included kind of large insurance companies. All of the non-bank originators, which actually originate the majority of home mortgages, are completely outside of the system. And a lot of the collateral they're using now are mortgage-backed securities that, again, for the reasons Don just described, are already very liquid instruments that already have a government component built in to the nature of the instrument. So you still have a lot of support from member financial institutions, but because you're no longer specifically supporting thrifts that are focused on housing, most of the benefits are flowing to members in ways that do not necessarily translate on to benefits for housing. There are still some meaningful benefits for housing. In particular, there is a small portion, 10%, sometimes a little more, but 10% minimum by statute, of the profits of the Federal Home Loan Bank system that have to go to various affordable home projects that are meaningful. But it's really a tiny sliver of the overall system and its impact.
Yeah, and mortgage interest rates are set overwhelmingly by the open market pricing of those agency pass-through mortgages, with the markup that the lenders, mostly these non-bank originators, will add, which varies on how competitive the market is at the time. in my 7 years, I don't think I ever heard anybody talk about the home loan banks lending against mortgages impacting actual mortgage rates.
I see. I have a quick follow-up question for Kate. So you were saying that the collateral that they put up right now is not as liquid, like, or is much more liquid than what they used to put up as collateral. Can you say a little bit more about that?
Yeah, I mean, so one of the reasons they were so incredibly useful when they first came onto the scene is one of the core challenges with any financial institution, whether it was a bank or a thrift, is this maturity transformation. You're holding longer term assets and you're funding them with relatively shorter term liabilities. And the core challenge is if, the way that you're funding yourself becomes unstable because of a depositor run or just a change, a shock to the overall system, that means that people want more liquidity, you're going to have to unload your assets, or you're going to want to find another way to convert them into something liquid. And so that's one of the core challenges. And part of what the federal home loan banks did is they took a non-liquid asset. That means that one is just, it's hard to convert to cash into a short time. So if I make a loan and it is a loan where I engage in careful underwriting, there's a really good chance it's going to pay off according to its terms. Nonetheless, it's really hard in a short window of time to convince somebody else of that fact. So there's a lot of frictions in those mortgages because it takes time to originate. And then if I want to sell it, it's hard to sell it quickly. That's no longer the case for much housing finance. It still is on the border. And so there is still the possibility of a very meaningful impact if you're engaging in kind of more innovative lending that is not single family residential lending. But for the majority of the housing market now, because of the agencies, it's just a much more liquid market. It's much more transparent. And so just to be clear, the federal home loan banks now can accept a lot of illiquid collateral. So they actually are now able, for example, for many of their members to accept things like community development loans. And there still are a lot of frictions. So there's still the capacity there to have a very meaningful impact in ways that could support lending that might not otherwise happen. But if you look at the collateral they're actually accepting, that's a tiny fraction of the business that they're doing.
And the motivation for people who have the assets that are already liquid to borrow is that their advances are subsidized. Whenever you talk about advances or liquidity, remember, it's all subsidized by the taxpayer.
Yeah. Well, we'll get to that. We'll get to that very soon. So Don, the federal home loan banks are not very well known, actually, right? Even many sophisticated financial people have hardly ever heard of them, and few who do really understand how they work and what they do. So why are we talking about federal home loan banks now? Like, what has changed that they're on the front burner of policy today?
By the way, preparing for this, I asked some of my friends from banking, retirees, do you know what a home loan bank is? And they all have heard of them, but if you ask, what do they do? You got a lot of stammering. So there's been a 3-stage of why they're now on the front burner of policy in Washington. One, for a long time, there's been concern about their growing use of subsidies, or the balance sheet has grown, not making its way to what was the considered mission related to housing and later expanded to community development. I have a little anecdote on that. During the Obama presidential administration, Treasury actually worked up part of a bill, a clause to do some reforms for the home loan banks. I believe it was during the first term, and to attach to another bill, and went to the relevant committees in Congress, and had zero interest in Congress in any kind of reform, and so it died. So this has been a long time, this insider of the housing policy community disenchantment. Second step is one of those members of the community is the FHFA, the regulator of the home loan banks, and the director of the FHFA, seeing all this and seeing how they've drifted so far from their mission, also in many technical ways, just oddities and things, after almost 100 years, 2 years ago said, I'm going to do something about this, and put out there that they were going to do this study generally called the Home Loan Banks at 100. That was your second step. But that was still relatively inside baseball and housing policy community And then, and Kate's going to talk about this later, the regional bank crisis hit last year. And all of a sudden, the home loan banks were the biggest lenders when these things failed, including to one of the banks, which was known as a crypto bank. And so a lot of people, including members of Congress, that is not the usual housing people, kind of imitated, what is it, meerkats, where they kind of stood up and went, wait a minute, what the hell just happened here? And that put them on the front burner.
Hmm. Yeah. So now, more and more people
Yeah.
are talking about it.
Yep.
Another, after you kind of outlined a few steps that have happened, but one other thing that happened recently was that the Congressional Budget Office released a new report on federal home loan banks.
Yeah.
They estimated the taxpayer subsidy that federal home loan banks receive. So they estimated that in 2024, federal home loan banks received $7.3 billion
Right.
in taxpayer subsidy.
Yeah. It was, the timing of that was excellent. The last time they did an estimate was, I think, in 2004.
Yeah.
I see. Yeah. So every 20 years they
Yes,
yeah.
basically.
Yeah. So, but $7.3 billion in taxpayer subsidies, but the federal home loan banks have long denied that any such subsidy exists. They say we receive $0 in taxpayer money. So, Kate, what is happening here, and how do we make sense of their argument that they're receiving $0 in taxpayer subsidies?
Well, I mean, subsidies take a lot of forms, right? So it's not that the taxpayers are writing them out a check, but the CBO analysis is an analysis by the congressional bureaucracy. They are very objective, and it's a really well done analysis. And it really took two forms. One, there's a host of regulatory and tax exemptions that are significant. And they say, on the whole, that's just shy of $1 billion in 2024 for the potential benefits. The biggest way that the federal home loan banks enjoy a very significant subsidy is by having an implicit government backstop, just like Fannie Mae and Freddie Mac before they failed and were put into conservatorship in 2008. And so the core idea here is the government, it's officially the instruments that are issued by Fannie Mae and Freddie Mac before they failed were not backed by the US government, but they were priced in a way, and they had certain regulatory advantages that really suggested they were likely to be backstopped in the event of failure. Federal home loan banks are in a very similar position. So they have a slightly different governance structure, but you have a similar effect where if you look at Moody's, they'll say, okay, here's what the rating would be without the government backstop, but we're going to move it up 4 notches because of the government backstop. And investors price it accordingly. And so it really gets treated, even if you think about kind of regulatory purposes, money market mutual funds that are supposed to be called government money market mutual funds and have a whole variety of other advantages because they're only holding government securities, can and do hold federal home loan bank debt. So there's a whole variety of ways that federal home loan bank debt, and it can be used for open market operations by the Fed. And so if you really look at what the advantages are that they confer, it is true that investors are the ones who are treating it like a government-backed instrument, but that's because the government is probably going to have an implicit backstop and very likely would have to make good on that backstop, in part because of other regulatory regimes the government's put in place. So it's probabilistic. I mean, most pricing in financial markets is you're trying to make probabilistic determinations, but it's a meaningful shift from where the risk should lie, which is just with the federal home loan bank system, to where it does lie with the US government and the taxpayers. And that's a very significant subsidy.
Yeah. I should mention, quite honestly, this is the government playing a bit of a budget game where they say they're not guaranteed, so don't put it on the budget. But to the market, they really are. And the most concrete symbol of that, since we talk about the home loan banks being banks to banks for liquidity, the home loan banks have a special line of credit at Treasury. So in fact, if they ever got in liquidity trouble, they can directly access Treasury. That's something no regular company can do. That's true for all the GSEs. And that is a big symbol of their special status, as well as all the other things Kate has mentioned. And of course, I actually had an interesting conversation about 2003 with the then head of Fannie Mae, in which he vehemently denied that they were supported by the government. And of course, when 2008 happened, the government came in and helped and saved every single creditor of the two companies. So the implied guarantee turned out to be very real, despite the denials previous.
Yeah, investors have to prove that the government stepped in case of trouble.
And
for Fannie Mae.
investors now go, well, we knew before that they might, now we know they will.
Yeah, yeah.
And the result is, by the way, home loan banks and the GSEs don't borrow at like a corporate AAA rate. They borrow at near treasury rates, better than any regular private sector corporate can do.
Yeah.
That's a big subsidy. And how much do they pay for this support? Zero. That's
Free
the subsidy. Free subsidy. Free benefit.
Sounds great.
Yeah.
That sounds great. So, Don, where does this $7.3 billion in subsidy every year, where does that go?
Okay, 5 buckets. First, highly transparent is their dividends to their members. I did some math. In 2023, last year, $2.8 billion of dividends. That's 38% of the CBO's $7.3 billion subsidy estimate. So about 3/8 goes right through them into their members through dividends. They talk about the low-cost advances, i.e. subsidized advances made to their members. That means they're lending at under market rates. There's no transparency about how much of the subsidy goes to loans that are made a little below market. You'd have to add up the difference for every loan and figure it out. But that's where some of the benefit goes as well, because if there's going to be a subsidy passed, that's the most direct way to pass the subsidy to their members, not later in the year with dividends. These two are connected. They're a seesaw. If you wanted to have lower dividends for optics, you could just make the advances even more below market, and your members will get them that way. If you want to look like the dividends are high, you could make the advances not so much below market. So this is a lever. Third bucket is currently mostly dormant. That's where they borrowed on these government subsidized rates and bought a somewhat risky investment portfolio pre-2008. Home loans banks did it, Fannie and Freddie all did it, and they all lost billions on it, including the home loan banks. It's all well documented in public. So the FHFA, as the new regulator at the time, restricted their ability to make risky investments in the portfolio. But if there's a lesson from the last almost 100 years, it's that those kind of rules can often get eroded over time, so they should be watched. Fourth, of course, is the Affordable Housing Program, the AHP, 10% of earnings. Some of the subsidy goes there. There's a lot of numbers around there related to calculating what you have to give, and it takes time to put it out, and it was last year's number. I was able to dig through their financials and find out actually how much cash they put out the door. It's an average in the last 3 years, $332 million per year. So that's a little less than 5% of the subsidy level per annum. So there's that. And some of these are loans, not grants, so it's not clear how much value is there. But the fifth bucket is my personal favorite. They're operating expenses. People don't talk about this enough. The FHFA report, which I highly recommend to anybody who's interested in this stuff, calls them out on this. Their expenses were about $1.4 billion a year for the 3 of the prior years, and then popped up last year to $1.6 billion. And you have to look carefully. There's some AHP type money in there. You take that out. This is salaries and rents and travel and all the usual stuff. If you take their current balance sheet, it's about 20% or over 20% of the subsidy. If you view this as a way the government set up to take this $7 billion subsidy and distribute it, that's a very high overhead cost. Their balance sheet actually is highly variable, and it's high now. Their operating expenses are not variable. They tend to creep up over time. And so actually the number is probably more in the 25% range disappears into their operating expenses. That's incredibly inefficient as a government subsidy program. Now, I'm an experienced financial institution manager. You go, why such high expenses? I have no evidence one way or the other whether they're just sloppy on things. But what I can tell you is that the 11 banks are all incredibly underscaled. They're tiny scaled. They have diseconomies. The average home loan bank has about 300 people and only about 600 member borrower customers, of whom only maybe half or so are borrowing at any time. That's like a small community bank in many ways. And the savings from sharing or doing this at scale would be tremendous. The FHFA report also calls them out on this. And the inside scoop from the government is all such efforts have been resisted. It's unclear to me why their boards don't go for these savings, but there it is. They don't. So they're very expensive. So a lot of the subsidy, up to a quarter maybe, just disappears in operating costs.
Yeah, even though, like what you're saying, they're not actually, unlike a commercial bank, they're not actually serving that many clients, that many members, right? Because their members are banks, right?
I had this later, but I'll do it now since you brought that up. So the average home loan bank has about 120 some billion in assets. So you look up banks that are about 100 billion, they're not that many. And I looked up what I'm familiar with, typical regional commercial bank. Instead of 300 employees, they have 9,000 and something. Instead of 600 customers, they have over 1 million. And instead of one product line, Advance's major product line, they have about a dozen plus 400 branches to worry about. These are extremely simple institutions by comparison to a bank of that size.
Yeah. One other small thing I want to just follow up on is when they are promoting their AHP program, they seem to trade in big numbers, right? It seems to be a lot, like millions of dollars. But then when you put it into perspective,
Right.
it sort of is much smaller in terms of what they could do. We're not saying that they're not doing anything; they're doing something. It's just very little based on their capacity.
I'm also, I think the AHP definitions of what counts and how needs work. Because if you're making a $10 million loan that you get back, that's not the same thing as a $10 million grant. And those are very different.
I see. Yeah. Great. Well, that's very helpful, Don. So the webinar started because you both recently published papers about Federal Home Loan Bank reform. So, and a theme of both of your writings is that the Federal Home Loan Bank, the sort of public benefits and the private benefits of the Federal Home Loan Bank are sort of out of whack, right? They're out of balance. So can you tell us a little bit more about this and what the underlying causes of this misalignment? So maybe, Kate, do you want to start on this one?
Yeah, I think there's a lot of different ways of trying to tackle this challenge. One of the core ways of understanding it is just in the evolution of the nature of their members, right? So when they started, the members were themselves cooperatives. Most thrifts were structured as cooperatives where they had a governance structure where they were really focused on serving members, and those members were themselves the borrowers and the lenders, these small community-oriented institutions. So by putting some control in the hand of members and benefiting members, those benefits by definition were passed along to the members of those financial institutions, the thrifts that were the major members. Today, the members are all kinds of banks. And the biggest banks are oftentimes among the biggest users. The largest insurance companies are among the biggest users, and banks that get into trouble. And hopefully we'll have a time to discuss that as well. And so as a practical matter, so one, you don't have the market discipline, as Don beautifully laid out. So there's just incredible inefficiencies built into the system because there's not a lot of market discipline and there's a big government subsidy. And the best way to exploit that subsidy, the best way to get the biggest subsidy possible is to do as much activity as possible, regardless of whether or not there's a real social benefit to it, because that's what allows you to have the biggest benefit that you're passing along to member financial institutions. So again, I don't think anybody in the system has an intention to do something bad. Like, it's not like people are setting out to do something bad. I think there's a lot of people in the Federal Home Loan Bank system who are like seeing their little piece of it, and they think that they're doing a good job because they're operating within that little piece. But structurally, the nature of the incentives that they have are to serve member banks. And so that results in, executives that are incredibly overpaid, institutions that are not all of that well run, and the majority of the benefits flowing onto banks in ways that do not create commensurate public benefits. So there's a lot of different possibilities for reform from that, but you can just like look at the structure of the institutions, look at the governance of the institutions, and look at who they are accountable to. And it's very far from surprising that the majority of the subsidy gets either absorbed at the level of the Federal Home Loan Bank or passed along to those member institutions, which at this point are themselves for-profit banking organizations.
Yeah. Don, I have the same question to you about sort of balance between public and private benefit.
Well, clearly the world of 1932 is long gone, where Congress intended to help and intended to subsidize those that didn't have access to the Fed discount window or later the regular bigger capital markets. And so it was these smaller community thrifts, and they were it was a two-part test. It's who you were, kind of a community institution. They liked that socially, and what asset was involved with the collateral, which was home mortgage lending, or this general phrase, community development lending, which has a lot of technical things about definitions. Fast forward to today, that's still going on, but it's a very small piece of their activity. The bulk of the activity is to medium and large size banks, overwhelmingly, who have access to capital markets and have plenty of liquidity. Their motivation, leaving out the regional crisis, is earn the subsidy. But you go, is that really who the subsidy should be for, or really Congress intended? That's on the books. So a lot of the subsidy is just not going to where you want. And the FHFA report actually intimates that the home loan banks are a bit lazy in doing the extra work necessary to handle the unusual assets of community development and very small institutions, or the Congress has added, CDFIs as community institution and credit unions, and trying to get that old school back, but the other stuff still dominates. The bigger banks taking, and it's about the subsidies. They don't need the liquidity. They like subsidized liquidity. Who doesn't?
Yeah.
You mentioned my article. This is not the evilness about the home loan banks. It's inevitable. Think about the Congress designing all the GSEs, all of them. They went, it's off the budget books. We want a private sector ownership, which means you have to earn money and get a return on the capital. But we want to design them so they have a narrow public mission, which requires subsidies, and we'll give them subsidies. How can you make sure those subsidies are used for the mission and not just drift into subsidies for profit over 90 years of changes in the markets? It's impossible. And Fannie and Freddie, where the public record is most visible, they drifted, and it became a lot of snarky comments where they use their mortgage securitization business as the excuse for subsidies. And the home loan banks are just sort of reproducing that same thing. And the design is the problem, quite honestly. That's the underlying problem. They're allowed to do this, and it's inevitable drift with human behavior.
Yeah. Yeah. I mean, we also put links to both your articles in the chat, so people can read more.
Right.
I want to get to the regional banking crisis from last spring. So just for Kate, many members of Congress were surprised by the large and controversial role played by federal home loan banks during this crisis. So what is the controversy, and what do the actions of Federal Home Loan Banks during this banking crisis kind of say about their mission?
All right. I mean, so the controversy is if you look at what happened to the balance sheets of each of the four regional banks in the period leading up to their failure, they actually started to lose deposits in most of the instances well before they failed. And they made up for those deposits by turning to their local Federal Home Loan Bank. So for example, if you look at SVB, at year end 2021, it had negligible borrowings from the Federal Home Loan Bank of San Francisco. By year end 2022, it was the single biggest borrower from the Federal Home Loan Bank of San Francisco with 15 billion outstanding, and that was 20 billion by the time it failed in March 23. Federal Home Loan Bank of San Francisco's second biggest borrower at that time, First Republic. So what, and again, this was surprising, I think, to a number of members of Congress, to a lot of actual people who are otherwise sophisticated in financial markets. It was not at all surprising to me, and it was not surprising to anybody who's followed the Federal Home Loan Banks. I actually first got interested in the Federal Home Loan Banks because I was really interested in trying to figure out how did banks get by during the early stages of the 07 and 08 crisis? And the answer there was the Federal Home Loan Banks. So if you go back to 07 and 2008, all of the banks that ultimately failed, including those that failed in messy ways, WAMU and IndyMac, every single one managed to stay alive longer than they should have, because as they started to get into trouble, rather than shrinking or rather than having to go to the Fed and say, look, we're in trouble, they managed to get the liquidity they needed to stay alive by going to the Federal Home Loan Banks. If you go back to the S&L crisis, which we discussed a little bit earlier, it was the exact same phenomenon. If you look at the thrifts that ultimately failed, they were far more likely to have borrowed, and they borrowed far more relative to their overall assets than the thrifts that were healthy. So the core challenge is the Federal Home Loan Banks always get paid back in full. They like to say they've never had a loss on an advance, which is true. But the very fact that they have never had a loss on an advance, even though they're oftentimes the biggest lender to all of the large financial institutions that failed, is not a point of pride. It should be a point of shame. It's a sign that they have incentives to be indifferent to the health of the financial institutions that they're loaning money to. So a real core challenge here is that instead of going to the Fed, which is designed to be a lender of last resort, where there's public accountability around the role it plays as a lender of last resort, the Federal Home Loan Banks continue to play this type of role, helping troubled banks to hobble along when society would probably be much better off if those institutions had to face resolution a little bit earlier.
Yeah.
The FHFA report tries to figure out the legitimate role of the home loan banks providing liquidity, even if subsidized, through the normal cycle versus inappropriately providing liquidity for a failing institution. That's a judgment call, and so it kind of really looks for more integration of the Fed to be aware of what the borrowings are and such of these companies. But that's going to be interesting to watch how you make that judgment.
Yeah, and how do you put those incentives in place, right? It sounds like currently
Right.
volume is the name of the game for them. So they can.
And to Kate's comment, the home loan banks do say they've never lost money in advances. Congress designed the advances so they wouldn't lose money because it's supposed to be like a discount window, always fully collateralized. When Congress didn't have it with the super lien, so they always get paid back. When Congress didn't design it up in their investment portfolio, they managed to lose billions of dollars just like others.
Yeah, so I do want to get to questions from the audience. So I'm just going to ask one more question of the panelists and then turn to the question in the chat. So if you have a question, this is your chance to start putting it in. So the title of this talk refers to structural reforms of federal home loan banks. So some of that is under control of the FHFA as their regulator, and some of it will have to go through Congress. So what should we be watching? What kind of changes do you expect to happen? And I'll start with Kate for this question.
So I think hopefully we're going to see really two stages. At least that's my dream stage. The FHFA report does a really nice job of laying out a number of important incremental steps that try to make the Federal Home Loan Bank system more mission focused and less profit focused. And that is a tall order, and there are structural challenges with trying to get it in that direction. But there are a number of concrete steps that are nicely laid out in that report that would help to make some corrections and really help to make sure that more of the benefits are going to housing or supporting credit in other areas where it's really needed, and a little less just being passed on to member financial institutions, and a little less just being passed on to the executives. I would say longer term, there is a bigger structural challenge where the system really was set up in part over time to enable kind of this off balance sheet way of operating, supporting housing, supporting financial institutions. We didn't get into the history, but that's really a design choice that was made in 1989. So when the government was trying to figure out how to deal with the fact that it had a lot of insolvent thrifts that it had to shut down, it wanted to fund that resolution without taking on explicitly the full cost of that resolution, because they were trying to meet some deficit reduction targets. And so their answer was to create these ref corp bonds that were fundamentally paid back by the Federal Home Loan Bank system, and then to allow the Federal Home Loan Bank system to get a lot bigger. And so that's how we started to have all of these non-thrift banks as members and a broader set of collateral. So we kind of used it as a way of doing things off balance sheet. And I would say longer term, there's still a really important role for the Federal Home Loan Banks to play. But it really has to go back to figuring out, well, what are the financial institutions that are helping to create credit on the margin that is credit that is socially useful and otherwise undersupplied? So where are there real frictions? And so that could be more innovative forms of housing. There's a lot of those issues around small business, but a lot of that would be a much smaller Federal Home Loan Bank system, one much more focused on smaller financial institution members, and one really willing to do the due diligence to accept as collateral some of the forms of collateral that are more challenging to value, precisely because they are actually helping to serve the needs of local communities.
Yeah. Don, do you want to chime in on this question too?
Yeah.
What's your vision?
In terms of what to watch, I have to mention the word lobbying. So the vast majority of the recommendations made by the FHFA can be done by themselves, but there are two types: one by normal supervisory work, the other has to go through a very burdensome and time-consuming rulemaking process, and a few have to go through Congress. The standard response here, which the home loan banks are doing and has been documented in the press, is ramping up a major political advocacy and lobbying campaign. And part of that aspect is to get congressmen more on their side. And so the general, I'd say, commentary is that getting something through Congress is a tough road. And they're trying to run the clock out at the FHFA on all the rulemaking, because the FHFA is a single director organization. The director now is Sandra Thompson. This is her project. When will she leave, and who'll be the next director, and when will it be? Will they want to carry on with this? Nobody knows. And Sandra, it's kind of complex. She has a term that is the earlier of a presidential administration changing, or 5 years from when she started about 2.5 years ago. So her term could literally end January of next year if Biden did not win re-election, or if at that time he just chose somebody else. And so the issue here is the history of reform efforts for GSEs, most of which were Fannie and Freddie oriented. Prior to 2008, the history is 100% complete failure.
Okay.
I mean, not to, not
Not
sugarcoating.
encouraging.
And those reforms have been made in conservatorship, but not before. And so Sandra Thompson and the FHFA is going to try to get done what they can, but this has to go past her. And the question is whether there's enough of a policy consensus in Washington with political support in Congress to keep going. And that's a TBD, which we should watch.
Great. Yeah, you also just answered one of the questions in the chat with that answer too, Don. So
Okay.
I think that's perfect. I want to raise this question. Someone is asking, could you make any suggestions for what local governments can do to help the intended beneficiaries of these programs? Or is this just a discussion at the federal level? Either one of you, I don't know who wants to take it. Kate, do you want to, or
Yeah,
Don?
I mean,
Yeah.
it's a really actually great question because it's a federal program, but it's a federal program that originally was designed to help state chartered institutions. So I do think that there actually is a very meaningful role for state and local authorities that are worried about credit creation in their localities to play a role in this ecosystem. I mean, so first of all, congratulations to everybody who's here. Like the first step is just getting people to care about the system and to realize it has both incredible distortions that it introduces right now, but also meaningful upside if we were going to use it to really harness some of the benefits that it originally had in terms of promoting credit creation. So I think a lot of the role that state and federal or state and local authorities can play is understanding your local community financial institutions, talking to them, learning from them where they feel like there's loans that they could make but aren't making because of liquidity or cost concerns, and then using that to help reimagine the Federal Home Loan Bank system, whether it's kind of loss sharing on loans or other mechanisms that they have yet to engage in, like understand, help play a role, I think, in the overall ecosystem. So that way people start to understand the role these institutions can play in actually helping your local communities and being a voice for showing the positive role that they could play if they were reimagined and the system was kind of right-sized, but also reoriented to really play a useful role in the margins in credit creation.
Yeah. Sandra Thompson has commented that the home loan banks actually have a lot of flexibility of how they can do lending and investing to help local communities, whereas Fannie and Freddie are more restricted in what they can do. I also note that the home loan banks are they're set up with the geographic regional banks, and then they have state offices. They're very tied into, call it the politics of local support. Local governments, quite honestly, should band together with or without the state to kind of organize against them, not against them as anti, but to face them with, here's the kind of programs we'd like in our community. Just don't go off doing yours one by one. We've gone through our town, and this is what we want you to do, because they are politically sensitive organizations for community support. So a little bit of, an association to organize to go to the home loan banks and go, these are the type of things we'd like you to do, might pay off.
Yeah, and it'd be helpful for them to mobilize and be a voice on this too, and
Right.
say, we have housing supply issues in our municipality, in our community. Why aren't you doing more to really tackle this crisis, right?
I don't expect to see any tent camps in front of the home loan bank offices, though.
No. I think it'd be hard, but some more engagement and mobilization would go a long way. I have a question here for Professor Judge. Why are insurance companies members of the Federal Home Loan Banks? How does that support housing and community development?
It's a great question because it's one of the key components that we have yet to discuss thus far. It really is a vestige of a different era. So rewinding back to 1932, I focused on the thrifts, and they were the biggest users of the Federal Home Loan Banks and the biggest issuers of mortgages, apart from individuals at that time. But insurance companies also actually played a meaningful role creating a secondary market for mortgages before we had the other GSEs. So before we had these other kind of government created secondary markets and government created securitization markets. So if you go back to all the hearings, part of the idea was, if we're going to try to provide liquidity for mortgage credit, let's look at where that mortgage credit is sitting. And the insurance companies did play a meaningful role at that time. Today, it makes no sense, right? So we've only expanded. We've never kind of retracted in terms of the size of the system. But really, if you look at the role that insurance companies are now playing, it is a mechanism of increasing the subsidy both via dividends and by low cost loans. It is by no means a way that you are meaningfully passing liquidity on to facilitate credit creation that you're not otherwise going to get. So I think if you were going to shift from what can we do at the FHFA level to what Congress can and should do, I think restricting insurance companies would be a huge step forward.
Right, yeah, I have another question here. This is about the benefits. So the idea, of course, of sort of these below market rate advances. The idea is that in theory, this would translate into lower mortgage rates for borrowers, right? In the 1930s, right, having access to cheap advances, some of that would translate into lower mortgage rates for borrowers. So this person is asking, well, do you recommend putting greater restrictions on the type of collateral that members can use? Or do we require member institutions to hold more mortgages on their balance sheets, as is required for new members? Kind of the idea. How can you make sure there's a greater benefit,
Right.
through this system?
I think you remember there always is the issue of who the borrower is under the advances and what collateral is being used. When a lot of the advances don't have whole single family mortgages as the collateral, you're not impacting the single family market. So one of the issues might be to restrict what kind of collateral back to their core. It's been expanded over the years. In particular, you wonder why government guaranteed mortgage-backed securities are allowed as collateral. I mean, there's not much there for social value. But I want to focus more on what Kate has made comments on. It's who the institution is. Larger banks have access to funding. So they're going to price off the marginal dollar. And if they get some cheap home loan bank advances, that's sort of just going to their profits because they're not going to price off that. They price off their bigger liquidity from their deposits or wholesale markets. Small institutions don't have that access. They're going to look at the home loan bank money as that core money, as that marginal pricing money. You got a lot better shot of them subsidizing their mortgages or their community development loans off of cheaper advances than, $1 trillion bank. So I think you come back to the issue of who are the borrowers. And if they're large, you don't expect a lot to make its way to the lending in terms of pricing. Small, you maybe do.
Yeah, I'm going to ask one more question, and then we're going to, close the webinar. So the question from the chat: could the federal home loan banks use their balance sheets to acquire assets without other easy liquidity sources, such as low balance mortgages, mortgages on Native American trust lands, or for manufactured housing, for example? Is that an idea?
They don't have untrammeled ability to just pick discretionarily their assets, no matter how much they might be socially advantageous. The investments they're allowed to make, investment securities, there's rules for the FHFA to keep them low risk. Maybe those rules could change and they could put things there if they're investment form, i.e. bonds, not loans. But right now that's meant to be a reserve of liquidity and not for making actual socially beneficial investments. Second bucket is advances. Again, Congress has kind of limited this to what's allowed and collateral. The direction of doing that was to allow community development lending. The FHFA report kind of criticizes the home loan banks for not doing enough in this space, being a little bit lazy with just doing easy home mortgage lending. So I think there's some ability to do it there. It's just a will to do that, although they have to stick to the definitions. And then the affordable housing program, the 10%, of course, the recommendation is that be raised to 20% or more. They have incredible flexibility of what to do there. And so that is the bucket with the most room to do things on a judgment basis, because there's not a lot of restrictions, because it was a separate category kind of on the side.
Right. Well, we are at time. Thank you to both panelists. This was a really rich discussion. We touched upon a lot of different topics within the Federal Home Loan Bank system. I hope that everyone leaves a little wiser about the Federal Home Loan Banks and can answer the question, like what Don was saying before, about what they do. There's always more to learn about these GSEs. So thank you so much. I hope you all will join CFA in future webinars and stay engaged in the conversation. Thank you so much.
Thank you.